Overconfidence and ego in trading, a hidden risk to your success. In the fast-paced world of trading, success isn't just about knowledge or strategy, it's also about mastering the mindset. While experienced traders often pride themselves on their expertise, one silent disruptor can derail even the most seasoned traders: overconfidence and ego. These psychological pitfalls can feel insignificant, but have the potential to cripple your trading performance. In this video, we'll break down how overconfidence and ego sneak into your trading habits, the dangers they pose, and actionable steps to eliminate them. By the end of this discussion, you'll have the tools to ensure your mindset becomes your greatest asset, not your biggest liability. Overconfidence often stems from an accumulation of wins or advanced market knowledge that leads traders to overestimate their abilities. This isn't uncommon for experienced traders who've enjoyed a string of successful trades or feel adept at predicting market movements. But here's where it becomes dangerous. Overconfidence creates a false sense of invincibility. Traders start to believe they're immune to significant losses, dismissing risks, or jumping into over-leveraged positions. This mindset can lead to costly errors, from underanalyzing trades to ignoring legitimate red flags in the market. For example, say a trader enters a bullish position after seeing minimal indicators of a stock breakout. Convinced of their market timing, they may overinvest capital. The stock either moves in the opposite direction or encounters unexpected volatility. What felt like a confident move transforms into a painful loss. Understanding this subtle but powerful shift in perspective is the first step in managing overconfidence. When you recognize it, you can reevaluate your trading processes and adjust your approach to avoid high-risk behaviors. Overconfidence doesn't just lead to risky decisions, it can weaken your entire trading strategy. One major consequence is the tendency to underestimate risk. Experienced traders often miscalculate their exposure or fail to diversify their portfolio because they assume their judgment is flawless. Another danger? Overleveraging. The belief that you know where the market is headed can lead you to allocate more capital than necessary into trades. While profitable trades may reinforce overconfidence temporarily, losses resulting from overleveraging can wipe out gains, and sometimes entire accounts. Real-world examples abound. Consider investors during euphoric markets, such as the 2020-2021 cryptocurrency boom. Many believed that continued growth was guaranteed, piling investments into markets that later crashed. Overconfidence, coupled with the herd mentality, blinds traders to changing circumstances and emerging risks. The bottom line: overconfidence protects your ego while exposing your portfolio. Closely tied to overconfidence is the trader's ego, a deeper psychological need to protect one's self-image. Ego is that voice inside you saying, "I can't be wrong." It causes traders to prioritize being right over being logical or profitable. This manifests in several ways. Some traders hold on to losing positions far longer than they should, believing the market will eventually validate their initial judgment. Others refuse to cut losses or reassess their strategies because doing so would mean admitting a mistake. The ego's hunger for validation distorts logical decision-making and magnifies risks. When traders are so focused on being proven right, they lose touch with the fundamentals of disciplined trading. Recognize that the goal of trading is not to win every time or prove yourself, but to maintain consistency, preserve capital, and secure long-term profitability. The combined effect of overconfidence and ego can severely disrupt trading discipline. Traders operating under these mindsets are prone to emotional biases that cloud their judgment. For example, holding losing trades, refusal to cut losses increases exposure to unnecessary risk. Ignoring warnings, dismissing feedback or market analysis because it challenges existing beliefs. Reckless trade frequency, entering excessive trades to prove trading prowess, often at the expense of logic and planning. These behaviors not only harm your bottom line, but also diminish your ability to learn and grow as a trader. Each mistake compounds the problem, increasing stress and emotional decisions. How can traders identify whether overconfidence or ego is impacting their performance? Look for these signs. Justifying losses, saying things like the market was wrong rather than analyzing where you miscalculated. Ignoring stop losses, moving stop loss levels to avoid losses instead of honoring your rules. Constant overtrading, taking unnecessary risks for the sake of excitement or validation. Refusal to seek feedback, believing external advice is unnecessary because you know the market. Ask yourself these self-check questions. Do I rely more on instincts than on data when trading? Have I ignored trading plans or rules because of gut feelings? Do I feel the need to prove I'm a successful trader to others, or even to myself? If the answer to any of these is yes, overconfidence or ego might be influencing your trading approach. It helps to understand that confidence, in and of itself, isn't harmful. In fact, confidence is a critical trait for success in trading. The key is to strike a balance, having enough self-assurance to make informed decisions without crossing into the territory of overconfidence. Healthy confidence stems from preparation. It comes from studying your strategy, reviewing past trades, and making decisions based on sound analyses. Overconfidence, on the other hand, bypasses preparation and relies heavily on assumptions and past wins. Recognize the difference by asking yourself, am I taking this trade because the data supports it, or because I feel it's a sure thing? When you root your trading in analysis and controlled risk, confidence works in your favor. Tackling overconfidence and ego requires intentional effort. Here are key strategies to shift your mindset. Practice self-awareness. Frequently reflect on your trades and decision-making processes. Ask yourself what factors led to a loss or a win. Was it skill, or was luck at play? Introspection helps you separate emotion from logic. Implement risk management rules. Build guardrails against overconfidence by enforcing strict risk management strategies. For instance, only risk a small portion of your account, for example 1 to 2% on any single trade. Set stop-loss levels and honor them no matter what. Avoid overleveraging, ensuring your investments align with sustainable portfolio growth. 3. Follow a trading plan. Use a detailed trading plan as your roadmap. It should outline specific entry and exit points, risk tolerance, and position sizing for every trade. Following the plan helps you stay objective and limit impulse decisions driven by ego. 4. Keep a trading journal. Log every trade you make, complete with pre-trade analysis, decisions, outcomes, and reflections. Over time, patterns of overconfidence or ego-driven mistakes will become increasingly evident. 5. Learn to embrace mistakes. Treat every losing trade as a lesson rather than a blow to your ego. By analyzing errors, you develop the humility and adaptability needed to thrive in unpredictable markets. Shifting your mindset means replacing ego and overconfidence with the desire to grow. Here's how. Commit to continuous learning. Even as an experienced trader, never stop honing your skills. Attend webinars, read trading psychology books, and stay attuned to market changes. Stay adaptable. Markets evolve over time. Strategies that work today may fail tomorrow. Maintain the humility to update your approach as needed. Detach from outcomes. Avoid associating personal worth with trading results. Profitable traders focus on consistency, not perfection. Losses happen. The key is to protect capital and improve strategy. Sometimes an external perspective can highlight gaps in your mindset that you might miss yourself. A mentor, trading coach, or peer can provide constructive criticism and objective advice to enhance performance. Cultivate a network of traders or professionals whose insights you respect and trust. This feedback loop reinforces personal accountability and helps guard against emotional decision-making. Overconfidence and ego are silent disruptors that can sabotage years of market experience. They foster behaviors that lead to reckless risk-taking, emotional biases, and avoidable mistakes. But by recognizing these tendencies, practicing self-awareness, and building discipline, you can protect yourself from these pitfalls. The key to thriving as an investor lies not only in your strategies, but in your mindset. Stay humble, stay adaptable, and most importantly, stay committed to growing into a trader whose decisions are guided by analysis, not impulse or ego. Thank you for joining us in this exploration of trading psychology. Take these lessons to heart and make your trading mindset your most valuable asset.